A lot of people are, no doubt, to Christina's point, watching. They're sitting at home. Maybe they're looking at their finances thinking, what do I do next year? So my question to you is this. What should they do next year?
Well, you have to hate stocks less than you hate bonds in this environment. And that's not the most ringing endorsement. But, the math is simple. Rates are really low. Even with this, and I'll say the word Santa Claus rally, we're trading at about 22 times 2021 earnings. That's very consistent historically with a 2% 10-year, and we're not even at 1.5%. So stocks are fairly valued. I mean, if you look back at earnings season, Q3, earnings were up 40% year over year, and that wasn't even such a bad comp. Going back to 2019, it's almost a 35% increase. So, we're in a decent place for equities. They're not defenseless. They can grow earnings and dividends, but those fixed coupons, they're totally exposed. This is not a regular tightening that we're about to experience from the Fed. It's going to start with tapering, and that should allow some level of normalization. Normalization means rise in those longer-term interest rates, putting much more of a damper on bonds and perhaps not that much of a headwind for stocks.
There's a very important point that you are making, Simeon. We'd expect nothing less, by the way, and that for the newbies out there, there are two T's, and sometimes you hear about the taper and sometimes you hear about the tightening. They are very, very different things. The tapering, the reduction of bond buying, the tightening actually raising interest rates, very different. Here's the question. We know we're going to get the taper. It's happening. We are likely to get a tightening, at least based on what they've said and everybody's projections. 1994, the Dow, there was 250 basis points, 2.5% of tightening, and the Dow surged in 1995. If we get higher rates, Simeon, can the overall market do what it did 20-some years ago and still move up?
It's all about earnings growth. And I think what some folks get wrong is they try to completely equate the equity markets to the bond market and look for shorter duration stuff, meaning the stuff where the earnings and the dividends are really front loaded. But that's not that much of a defense historically. The wrong place to look in the equities are places where you have very high dividend yields and not that much growth, because it's growth that allows the equity market to persevere in the face of some rising rates. So I think as long as you're looking to where the growth is and not trying to sort of engineer a short duration equity equivalent, you have a really good place to be in the equity markets, even in the face of rising short-term rates driven by the Fed.
Okay, so there's our macro convo. Let's help our viewers and listeners, Simeon, make a little money with some individual names next year. A lot of people out there, we talk about infrastructure, home renovations. They're going to be not only buying a new couch, but maybe things like new home infrastructure, water heaters, et cetera. A name like A.O. Smith, one you like.
Sure. We're big fans of dividend growth at ProShares. Folks know the S&P 500 dividend aristocrats and NOBL, the ETF. A.O. Smith exemplifies what it means to be a company that consistently grows its dividend. It's grown it for 28 straight years, 17% compounded growth in the last 5. That's your protection from inflation. Now, you missed a little bit. They did have a pop on their last earnings release, but that has not erased over 5 years of underperformance in the face of the large cap tech run. If you want a valuation point, you're looking at the same enterprise value to EBITDA multiple as the S&P 500, but 3 to 4 times the return on assets. So that makes sense.